Hi guys, welcome to the tutorial. We will continue looking at the common Forex terminologies. There's another terminology which is called leverage. Now, leverage is something that is used in the currency markets. Whichever money that you have got, you can ask your broker. You can set the leverage for that particular capital. You can go take a position at a leverage of 1 to 1, 1 to 10, 1 to 20, 1 to 50, 1 to 100, and even leverage of up to 1 to 400. Some brokers will provide that. Now, what does leverage do? We've taken an example of 100 to 1 leverage. It means that if you have a capital of say $100 in capital, you're able to pile into a position worth $10,000. At a leverage of 100 to 1. Obviously, it's 100 times your $100, and then you get a position worth $10,000. Now, there are advantages and disadvantages in doing this. The advantage, obviously, is that you can leverage and make a lot of money because you're trading a huge amount for very little capital. You can very quickly. In percentage terms, if you are on the right side of the market, you can significantly increase your capital. But on the other hand, in the same way that you can significantly increase your capital, you can actually lose quite a lot of money as well. So this leverage, you've got to be very wary. In a sense, a leverage of 1 to 100 is way too high. 1 to 10, 1 to 20 is a normal sort of range that many people will probably go. Not too big. You can stay 1 to, so in a sense, 1 to 10, 1 to 20 leverage position. But going up to 50, 100, 400 is not advisable because any small movement in the market will completely, very quickly, if it goes against you, could very quickly wipe out your capital. So whilst leverage is good, it's got its disadvantages. It can add to your capital, but then you've got to be aware that it can completely wipe out your capital if the market goes against you. So obviously you've got to be very wary. Again, it's just looking at that leverage again. For that same thing, $10,000, if you had the leverage of 200 to 1, it means that you're only putting up a capital of $50. So you use $50, and then you take a position of $10,000. Again, this is very extremely high leverage, and if market does go against you, it can very quickly wipe out the capital that you have invested. So you've got to be realistic in terms of leverage. Far lower leverage position should it's perhaps better. You can have leverage of 1 to 1, 1 to 10, 1 to 20. Those sort of levels are more perhaps much better in the sense of the movements do not wipe you out so completely. Huge leverage means you're taking on extremely high risk for the capital that you're putting into the market. Then let's look at the major currency pairs. The big or major currency pairs are the Euro USD, the pound, and the dollar, the dollar and the yen, which is called the USD JPY, and then the dollar Swiss francs, which is as we saw before, the USD CHF. Now these are the one of the biggest traded pairs. They are the 4 major currency pairs. There are others you can add to that. The ones that have got the Aussie dollar in them are quite can be added to these major currencies in terms of the trading volumes in a day. The Euro USD is hugely traded in a day, and in a sense, if you're starting out and you specialize in these 4 major currency pairs, you'll probably find that you could very quickly get to know the currency pairs This is a marked difference from, let's say, if you were trading equities, where you've got perhaps 8,000 companies that you could choose from, and you've got to do research upon research to narrow them down. But here there are the major ones that you could very quickly use to learn is these ones: the euro dollar, the pound dollar, the cable, and then the dollar yen, and then the dollar Swiss franc. You can expand that to include the Aussie dollars. But in terms of looking for opportunities in the market, there are plenty more currency pairs which you can have a look at, but these are the major ones.